today. This is an apartment complex we bought and sold. And so we'll get to kind of talk about what we call a full cycle, right? Buying it, executing a business plan, and then ultimately selling it, which is an important thing. If you're going to be buying and selling apartments, it's really nice to have some of those full cycle deals up so that you can point to the beginnings of a track record, right? Which is really hard to get a track record, but once you get it, it creates such momentum. It's almost hard to stop capital coming in once you actually have a track record, which is pretty wild. So we're going to dive into that. We're going to share a deck here with you with some great information in just a moment here. So bear with us while we get that going. So it'll be myself presenting. My name is Devin Elder, my co-host Abel. Good afternoon. How are you, sir?
Man, I'm doing great. Thanks a lot for having us on. As always, my friend, doing a good deed, sharing some good information for other people that want to do exactly what you're doing, man. So I love it. I love it.
Yeah, it's fun. We talk a lot about deals and the terms and how to put deals together kind of in theory. It's always nice to talk about an actual case study where we can talk about what we actually did, what went according to plan, what we had to be nimble about, and all that stuff. So we're going to, again, just getting some streaming set up now, and then we'll have our presentation pull up here in just a second, and we'll start walking you through this.
I see we're officially live now.
All right.
Facebook,
so we've got our Apartment Educators multifamily case study today. I'm one of your hosts, Devin Elder, and my co-host, Abel Pacheco's here. We can kind of jump into our presentation here. And Abel, do you want to talk about the vision and some of this first kind of intro here, since I'll be talking about the case study?
Yeah, let me go and take the first part.
Beautiful.
Super excited. We started as an in-person meetup in San Antonio, Texas, really building the premier multifamily meetup of our kind here in San Antonio. And, it started with 6 people, then we went to 10 people, then we went to 30, 40 people, back down to 6 again. And then end of the year before COVID, probably pretty close to 75, 100 people in one room, all focused on learning as much as we possibly could about multifamily, about syndication, about investing, about how to do it, how to invest wisely, and also how to find and finance, fund, execute, and as we're going to learn, go full cycle on properties. And that was really how we started this multifamily meetup. So we're super excited that you're here joining us virtually, because as soon as COVID hit, we've been doing this virtually. And I believe at the end of this, we'll have our May the 25th. I think we'll highlight some links. Our first in-person multifamily meetup since COVID. So we're doing that in May, and then we've got a big event in June. But the purpose for this is really to, as I mentioned, come together, educate each other, learn a little bit more about investing in multifamily, and then have an opportunity to network. And that's what we obtained by doing this. So we are appreciative that you're out here and look forward to having you. So that's our meetup vision, and sponsored by Apartment Educators. So if you don't know a little bit about Apartment Educators, go check out the website, apartmenteducators.com. If you want to join the Facebook group, there's a lot of content, a lot of free information on how we buy apartment buildings. So you're going to learn a little bit more about what we do, plug into the ecosystem, be part of the networking that goes on in that ecosystem. Is probably one of the most valuable. If you talk to anybody doing deals today in multifamily and syndication, they'll tell you the networking is probably one of the most critical components. Education is such a small percentage. The mindset and your network and pulling things together, this is what Apartment Educators does. So we are, sponsored of. I'm a coach for. Devin is also a big part of it, obviously. Yeah, actually, this is funny because I begged Devin to coach me and mentor me for quite a while. And he goes, no, I'm just super slammed. I'm busy. And then out came Apartment Educators a couple of years later. I'm super blessed, super grateful that he's even spending some time here. So thank you very much. It's our sponsor. Keep moving. And if anybody has Q&A, there's a Q&A button on the bottom as opposed to using the chat. Put in your Q&A as they come up, so it's easier to keep track of it. So please ask any questions during the presentation. We'll get to them at the end. And Thank you all for joining. So we'll go through the agenda, Devin.
All right. So we'll talk a little bit about myself and Mr. Pacheco here. We'll talk about why multifamily. And then the majority of this will be the case study talking about a specific project. And then we can take your Q&A. We'll answer the Q&A. We'll do the A. We'll do the answers at the end. But start throwing the Q's in now. Like Abel just said, you got a Q&A box below. So you got questions that pop up at any time, just start throwing them in there, and we'll handle them all at the end. Okay, a little bit about us. My name's Devin Elder. I was born and raised in San Antonio. I had a pretty traditional trajectory, college, and then a corporate job. But that really was, I couldn't see a way within the corporate structure and this trading time for money to get where I wanted to be, both financially and from a freedom perspective. Both very, very important to me. Not just the money, but also the freedom and the ability to kind of spend my life as I choose, so to speak. So became a real estate entrepreneur and started out with a six unit apartment complex, and then 75, and then 130, and ending up with now I'm a principal in close to 3,000 units of multifamily. It's crazy even when I see that number to think about that, but they just came from putting one foot in front of the other. And now we teach other people how to do the exact same thing. I'm about to literally walk you through how we did one of these deals. I like sharing. I like continuing to build my group of folks that I work with, people that I invest in their deals, people that invest in my deals, people that I can be a partner to. All that comes through networking and education events just like this. So that's why I'm here. Abel?
Yeah. Hi, everyone. Abel Pacheco. I am the president and principal of Five Talents Commercial Real Estate. And a little bit about me. I'm a single family investor. For 10 years, it took me to buy about 8 properties. And all of a sudden, I learned a little bit more about multifamily syndication and go from 8 to 800 in under 2 years. And I'm a multifamily investor, syndicator. And essentially from my standpoint, multifamily commercial real estate investing has changed the trajectory of my life. So I am pumped, super motivated. My whys, I have a 3-year-old and a 1, and my beautiful wife. And we were investing for years in real estate. And I heard that saying that many of the world's millionaires are created by real estate. But after 10, 12 years of single family investing, I could look at my net worth and say, well, I'm not a millionaire yet. What the heck happened? And I learned there's a different way to do that. And as soon as I, figure out there's a scaling part and raising capital and going to do bigger deals and leveraging commercial real estate, there you go. There you have it. So I was super excited and crossed our first, and now we're on to our second, and we'll just kind of keep moving. So I'm here because this is essentially what I love, giving back. I love teaching. I love coaching. I love helping other people succeed, because so many people have helped me succeed through the years. And it's an amazing process to see this come around full circle. Additionally, we have an opportunity to network. We either need to find more deals or find more investors. So this is an opportunity for all of us to kind of stay in that forward progress or momentum with each other and go partner up on a deal. So I look forward to working with you. I'm also a podcast host and a commercial loan broker now. So if anybody needs help with that, a lot of education, a lot of content we kind of continue to push out, and happy to help you all. So thank you very much.
Excellent. Let's talk about why multifamily. Abel, you want to kind of give the high level on this? Like, why are we even pursuing this asset class as an investment?
Absolutely. So I kind of given my story on single family, the multifamily part of it, it creates so much better opportunity to team up together, to pull our capital together, to buy something bigger than what we would have been able to buy on our own, and to have the opportunity to create wealth in a different manner than single family investing, where you are an active individual trading a lot of time for a lot of money and hoping for a return. This provides a return of cash flow and equity in a solid, stable investment that kicks off a passive investment, which means our money is working when we're not. You have the saying, if you don't find a way to make money when you sleep. You're going to work till you die. Mr. Warren Buffett. This is just a really great opportunity for us to do that. And the tax benefits are unlike any other that I know of. And if you know of a better one, let me know. I haven't found it, but on the parts of tax benefits for commercial real estate investing, it's essentially you're squeezing 27 and a half years of depreciation, and you squeeze it in the first few. And for those that don't know those terms, it's okay. You basically take it to your CPA and the expert to help you, and they'll show you how to get some great tax losses as you're investing. That's ultimately it. Some tax sheltered investments. So we love multifamily for all those reasons. It's very scalable. You can team up together and go do it. And it just performs very well, especially as this 2020 has proven for COVID. And you really realize, man, if you're in the right market, if you don't over leverage, then you're going to have a great opportunity to make some good returns. So as a passive investor, man, you leverage experts and pros, and they help you build wealth through your investing in multifamily. So that's why we're invested in multifamily.
Excellent. Yeah, just some high level reasons there. We like this asset class. Held up very well over the last year during COVID, very well. So let's get into the case study, right? Look at this beautiful pool. Makes me want to just dive right into that gorgeous pool.
Yeah, baby. Hey, this is one of the first pictures that I saw that I go, man, I got to get invested in this stuff. I'm invested in the wrong thing. And in transparency, I was an investor in this deal with Devin. This is my very first passive investment.
No way. Was it really your first one? That's awesome.
This is it, baby. 124 units. I love it. Let me. I don't want to steal your thunder, but I was excited about it.
Yeah. 128 actually.
128. Stand correct.
Yeah. This kind of interesting. Like you could see the coping around the pool, and you can see the concrete. It's actually in really good shape. This ownership group, hopefully they're not on this call. The ownership group we bought it from, I won't trash talk them too bad, but they had it for about 5 years when we bought it from them. They hadn't done much, which is kind of what we want. We kind of want some ownership. We want to ideally buy from ownership groups that haven't really kept up with it. Maybe they've let some things slide. Maybe it's kind of on autopilot, and we can go in and make some improvements. But the ownership group before that, so 5 years before I bought it, really like put a lot of money into it. So you could see that somebody had spent some money, and then somebody had done nothing for 5 years. So the pool looked really good. There's a nice pergola that they'd put in there, but the rest of the property was just neglected, I think is the polite term to use. And that's all right. That's kind of what we want. We want to create value. That's what the name of the game is. We want to get returns for investors. And if you can get returns for your investors, you as the operator, you're going to be taken care of. So it's 100% investor focus all the time. And if you take care of that, the other stuff works out for you. So just a nice little kind of picture there. Just some quick takeaways. If I were to see this deal hit my desk today, what do I like about it? Ooh, pitched roofs. I like that. I can't really tell from the condition, but the roofs look okay. And then we've got some stone exterior. We like that. Right? Stone exterior, even if it's dirty or dated, it's a tough exterior material. We like that. And that was the case here. So we can jump in a little bit further. Okay. This is the 1048 is what I renamed it to. It was called Fairway Manor before. And because it was on the fairway of a golf course, actually. And behind, this is in Seguin, Texas. So if you look at San Antonio and you look at Austin, Seguin is kind of like in between them, off to the east a little bit. A pretty small metro, actually. I was a little concerned about the kind of financing we're going to get, and was this market going to be too small when I was looking at this deal. But obviously, it all worked out fine. But it was 128 units, Seguin, Texas, a little bit north of San Antonio, and for the lender who was in Chicago, they were like, yeah, that's San Antonio. They kind of lumped it all together, even though it took me about 45 minutes to drive out there from my office, which for me is a hike. I like my assets 15 minutes from my office. I want to go see them all in one morning if need be. So this was a little outside my little bubble that I like to operate in, but that was fine. It was close enough. This Class C property built in 1973, purchased in October of 2018 and sold right around 2 years later, a little less than 2 years. So that's kind of the high level. And you got a nice aerial view. You can see on the top part of this picture that there was an old golf course back there, which is defunct now. And in the bottom part of this picture, you can see that land just to kind of indicate Seguin's growth. That land has been purchased and somebody built houses all over it and sold them. So, I mean, there's land in Seguin and a lot of people are building houses out there because it's still affordable. So we like the growth trajectory of Seguin. Honestly, this probably would have been a great property to hold on to for 10 years. But selling it's great too. You can't go wrong taking a profit, right? You can't go wrong taking a profit. So that's what we did. We took some chips off the table and that allowed me to continue growing the company, right? So that's kind of the high level overview. We can jump on here to the next slide. How do we close this deal? It's all about team, right? And just keep in mind that when you're looking for deals and you have some sort of, or just working in this business and you have some sort of a deficiency, I can't do this or I can't do that. It could be anything. You really can plug in a partner or vendor to fill that gap. So I can't find a deal. Well, there are brokers eating the phone all day, every day, trying to find you a deal. Use them, right? I don't understand all this legal stuff. PPM, operating agreement. Yeah, that's why you hire an attorney, right? Of course, you're going to hire an attorney. I don't quite understand how to put deals together and how to structure my business. Great. Apartment Educators is a consulting company. We'll show you all that stuff. We'll show you exactly how we do it, and we'll walk you through it from your education to actually closing a deal, right? You can leverage other people for any gap that you have. So that's what I did. I had a broker actually representing me as a buyer's broker. Even though this was marketed by another brokerage, I had a buyer's broker I had a relationship with. She represented me on the buy side as the buyer. We built a team, including an attorney, an insurance broker, a loan broker to find us the debt for the deal. And then once we closed, we had contractors out there. So it was like a whole team of people. Quite honestly, over the 2 years we had this deal, I probably went there. I probably could count on both hands how many times I went there, right? I just didn't have to go there that much because my team would see pictures of stuff. I would pop in every now. If I was driving to Austin, I'd kind of detour and go check it out, just kind of unannounced. But there wasn't much for me to do on site, which is the point of this business, right? You want to build your team and oversee the execution of it, but you don't want to be there every day, especially on these bigger deals like this, right? So you got if I haven't said it enough, you got to build a team. You got to get great vendors in there. And then I set up a syndication. So this deal required some money from the bank, and then it required a little over $2 million of investor money. So some of that was my capital that I put in the deal, and some of it was from investors. Able was one of them. And we got a group of about 20, 25 families together to come in and put up the money on this deal. And guess what? We all benefited. Now, as the person running the deal, I get a bigger piece of the pie, right? And then the investors, they still have most of it. The investors had 70% ownership of the deal, and I've got 30. Well, 30% ownership on a large multi-million-dollar transaction, that actually translates to a good amount of money, which is good. And that's as it should be. The sponsor should be compensated because they're doing all the work. The passive investors, they own the 70% of the deal. Well, they really literally had to do nothing, right? Other than decide, yes, I want to be in this deal and write the check, and then just read our monthly updates, get their distributions. There's really not much to do there as a passive investor, which is a beautiful model, right? The sponsor can get paid more to go do all the work. The person that just wants to write the check and be hands off, whether they just want to kick back, they're retired, or maybe they already have a job and they don't want another job. You could be in 10 passive multifamily investment deals and be working 80 hours a week in a corporate job if you wanted to. And literally you could make that work. You can't have that 80-hour week corporate job and go buy 3 deals as the sponsor. Like, that's not going to work. But as a passive investor, we know passive investors in 10 deals, in 20 deals, in 50 deals. I know guys that are in 50 passive deals. It's crazy, right? And It's a beautiful model because it scales very easily. So we set up that syndication, got a group of families together, put the money together, and that's how we raise the capital. And this, of course, is all through an attorney that's helping set all this up so that we're compliant with SEC requirements, et cetera, right? Completely legal setup. And frankly, if you drive around and you see apartment complexes in your town or in San Antonio, most of them are probably owned by a syndication, which is just a group of investors go out and buy this thing. So that's what we did. We're not reinventing the wheel. We just, we're just doing what I had been taught by my mentor many years ago, how to go do this. So that's what we did. That's how we closed the deal. All about team. We can move on here. And we got, let's talk about some of the, this is the little bedroom here. You can see how fancy our our model is there. Debt terms. So we got a bank loan for about 80% of the project. This was a bridge loan, meaning that when we bought this property, it was 70% occupancy, which is low, right? That's low. And that was just people in the buildings. That's something called physical occupancy. How many bodies are in there? Economic occupancy, how many people were paying, was more like 55%. So it was like not good. I told you this thing had kind of been neglected for about 5 years. And that's really why we got like a really good price on it, is because it had been neglected. So we got a loan for 3 years and with the option of buying 2 one-year extensions, which we didn't need. Little higher interest rate. You'll see 6% interest rate, which like in today's world is crazy, right? We're seeing interest rates like in the 3s now, but this is a different world we're living in now. It's a 30-year amortization, but it was actually interest-only payments, which helped because for the first year, actually, we told investors we're not going to have any cash flow distributions because we just don't know if we're going to have cash flow. Like there's too much work to be done. Occupancy was low. But we knew we had a plan, right? We went in there with about $1 million that we spent, and we put that money in there, and we turned it around, filled it up. And I think at one point we were 100% full on this property. Absolutely amazing. Absolutely amazing. So you hear good and bad things about bridge loans. You know, if we gotten to 3 years ownership, we would have needed to bought an extension for another year. And if we got to 4 years, we need to buy another extension to 5 years. And if we got to 5 years, we owe the bank their money back. So don't get to that point, right? You need to have a plan to get out sooner. So some people are scared of bridge debt. And I just think about bridge as like think about it like a gun, right? It could absolutely kill people for sure. That's what it's, you know, it can do that, but with safety and training, it's a tool. So the debt is a tool. You want to use it the same way. You want to be very careful about it and strategic, but if you do it right, it's an okay tool to use. So that's what we did. The intention was to refinance or sell within that period. We did that in 2 years. So we were fine there. So that's kind of a high level on the property there in terms of the debt that we went with. So we can move on there. This is a quick snapshot of a pro forma, and I'm not going to read this off to you, but I will notice, I will point your attention to our average monthly rent of about $747, and we had that going up marginally. I think we were able to get those rents much sooner. Another thing we did was we took our year one vacancy was 30% for the whole year. Like that's really conservative in from an underwriting perspective. We also had our expense ratio the first year at 71%. So high expense ratio. And that gave us kind of some cushion, but I'm not going to read everything to you here. This is a financial model that's very common to see a 5-year pro forma on multifamily. This is saying, this is what we think we're going to do in 5 years. Clearly we didn't hold it 5 years. So what I'm looking for as a metric is, what is the average annualized return to the investor? That's really the number. If we're going to sell inside of 5 years, what is our average annualized return to investors? And if we can get what we were projecting or beat it, then we may entertain a sale sooner than 5 years. So that's generally how it goes. And listen, pro formas are frankly, they're guesses, right? We're making a lot of assumptions on what's going to happen in the future. I was talking to a good buddy of mine yesterday on the phone who is an investor in a lot of multifamily deals. And he said, it's really difficult. It's very relationship based because he said he's been looking at pro formas, things like this for 5 years. And he hasn't seen a single one he didn't like. They all look good. If somebody's raising capital for a deal, guess what? The numbers look great. And you can make the spreadsheet say whatever you want. And that is true. You can do that. So if you're raising capital or you're putting a deal together, the model is important, but it's just a guess. It's just assumptions. What you really need to do is feel confident about your ability to execute. And people that are investing with you need to have faith in your ability to execute. It really is about the team you're investing with. Because these numbers are just projections, and so many things can change with taxes and insurance and global pandemics and things like that. I mean, you're going to get curveballs, period, in business. There's just no way around that, right? So you're really just investing in the team, and if you think they have the ability to pull this off. So that's just kind of a quick look at the financial projections on the property. We can move on to the next slide here and talk about why would somebody invest in this project? Well, this was a 506B offering. This is an exemption from the SEC, the Securities Exchange Commission, that says basically anytime you're putting capital together for a project, and I'm simplifying this, but if you're putting capital together for a project, that is a security. You're selling a security. And if you're actually selling security, it costs a lot of money and it costs you a lot of time. Us that buy apartments, we don't want to create a security. We want an exemption, right? So you want an exemption from the SEC, and that's what we got here, a 506B, very common. We had an 8% preferred return, meaning that of all the profit that the property spit off, that the first 8% of that went to investors. And we targeted like an 18% annualized return over the life of the project. And we delivered something like a 19 annualized average annualized return. So we beat it by a little bit, which is good because that's what we want to do. We want to overperform on our projections there, right? So we did that, and then while we held it, we were able to pass along some depreciation to investors, which helped them in that first year of ownership. Buildings are depreciated, and you can use that as a tax write-off or a loss, right? So we're able to pass that through to investors. We can move on here to the next slide. Our business plan was really kind of the same as it always is. As a new asset and property management, so we brought in a property management team. We did a rebrand. It was called Fairway Manor. I rebranded it the 1048. That is the address, 1048 Country Club Drive. So there you go. Pretty fancy branding there. CapEx, capital improvements and property improvements. We spent about $1 million. You can see in the back there's my old Tesla near the sign, but you could see the solar screens on there. You could see the trim pops a little bit. It's a white trim. We didn't paint the buildings. They were in decent enough shape. And we did a lot of interior renovations and then just things like landscaping and things like that. And the overall goal here is to increase net operating income and reduce expenses. So that's what we did. What do we have here next? Oh, there you go. Okay, some numbers. 1.3 million total. So interior rehab, we spent most of our money on the interiors, and some of them were rough. Were really, really beat up. But really, if you're standing in an apartment unit and it looks rough, really, you're just talking about some sheetrock, maybe some texture and paint. You're talking about new flooring. Maybe you got to replace some appliances. Like there's nothing that difficult. It might look bad. It might smell bad, but there's not that much that you need to do to make it look completely renovated and beautiful. So we spent most of that money on the interiors, making them nice. And then the exteriors, things like paint, the rebrand, and some, you actually can see some of these private yards that we did right here, kind of give it a little more modern look. We had 8% budget contingency and a 5% construction management fee that we paid to our property management company to run all the construction. Like, I didn't want to be up there every day. I didn't want to be up there every week. Our property manager was. I wonder if she's on this call. Thank you. Roxana. You did an amazing job on this project. And that prevented me as a sponsor from having to go up there every Friday and write checks to the teams and stuff like that. That construction management fee was built into the budget from the very beginning. Pay somebody else to oversee the construction. So all in, we're at 1.3 million on the renovations, which is pretty heavy. It's about 10 grand a door, all said, which I would call like a heavier lift. These days you're probably looking at 5-10K a door renovation budget. So this was kind of on the upper end of that spectrum there. We can move on here. Nice orange door there, you can see. Some kind of before and after. We kept the bones of the sign there. Obviously, have kind of a nicer day on the before picture, but we created a new monument sign there very cheaply with just basically a cover. Easy peasy. We're not creating the next downtown Dallas hotel here, right? We're just making it nice because we're kind of catering to a demographic that's earning the median income, maybe a little bit more than the median income, right? So we want to just kind of clean it up and do some things here, like putting in black appliances, and we got those little cabinet pulls, like really like minor touches that don't cost that much to make this a nicer living experience for folks. And in some cases, like curing if there's holes in the walls or the floor is torn up, we're fixing that stuff. But pretty lightweight. Like that's one of the reasons I love multifamily. There's just I've done a lot of renovation types of projects in my life and career, and like the multifamily ones are frankly not that difficult, which I love. We can move on here. Some more interior shots. We went from a beige scheme on the left to more of a gray scheme on the right there, but again, pretty simple stuff. So I know we've got some Q&A come in. So I've got a question from Omar I want to answer. What would be the motivation to go with a bridge loan on a 90% plus occupied property? I would say a bridge loan is potentially a fit for a multifamily project, even if it's stabilized occupancy, if there's a lot of work to be done, or if the property is currently underperforming and you want to go in and spend some money, get it up to a better performing level, and then either refinance or sell. I would say that a bridge loan can be a good fit there. I also advocate working with a loan broker, somebody that lives and breathes this stuff every day and can guide you through this process, because it's always changing, right? The lending landscape is constantly changing and evolving, and depending on what a bunch of different factors are influencing that. So I like having a loan broker in my corner to kind of guide me through that. The same way you have an attorney in your corner and an insurance broker to kind of guide you through the ever-changing landscape to determine if a bridge is a good fit on a project. Great question. Got a question here. When you consider organic rent growth and value add rent growth separately, do you sum both to have a total rent growth and a pro forma? Yeah, I like to separate them. So I like to say, if we just kind of maintain, we assume that there's going to be some organic rent growth over time, 2-3%, right? Maybe in other markets, 4% or more, but you're just going to naturally, rents are just going to grow over time, like with inflation, right? But then you're also going to have a separate line item that says, hey, we're renovating these units and we're going to actually be able to get more rent because we spent the money on the interiors. And so that's a value add rent growth. And yeah, you do sum those together in your pro forma. Great question from John. Did your occupancy go down before it went up in order to get the upgrades going? Yeah, we did. But it wasn't really so much. So we bought it at 70% occupancy. We took it down about 55% and then back up to 100%. That was really just because of the quality of the tenant base. Because if you buy a property with 70% occupancy, you've already got a lot of work to do. You've already got a bunch of empty units you can start renovating. That really wasn't our problem on this property. Our problem was you just had criminals in there. You had people that weren't paying. You had people that just shouldn't have qualified to be there in the first place. And we had to like cycle through a lot of that. So we had to get those folks out of there, because you're building a nice community here. You can't have this criminal element around ruining it for the majority of hardworking folks that are living there. So we needed to just clean house on a lot of the tenant base that was already in there. And that was why our occupancy dropped, not because we needed access to units to renovate. So if you buy a 95% occupied property, you might have a hard time finding units to renovate. But on a property that's already at 70%, you've got so much room to run on your renovations. Great question. Great question. So, if there's any more questions, please pop them in. Otherwise, we're going to jump to talking about kind of what's ahead here, upcoming events. Abel, do you want to jump in here and give everybody a look at the future here?
Sure. Yeah, I can absolutely. Thanks for covering all this stuff. That was really good. As Devin talks through that, I'm remembering what was going through my mind too as a passive investor. I didn't know that you can invest with 401k money at the time. We met. Let's see. I went to Devin's website. I started consuming a bunch of videos, and he's got a bunch of content on the site. And I was like, okay, I'm gonna check that out. And then I set up some time for lunch. And this because I, had already known him, but hey, I was like asking him, hey, how are you doing this? Well, let's go to lunch. And I didn't even have time to drive by the apartment complex. He had said, not this one, but you were working on another down the road. And you go, well, I'm working on this other one if you want to see it. And I remember saying, man, I got to be back to work in an hour. So I didn't have time to go drive by, but we talked a little bit and Devin said, well, a lot of people, really don't even step foot on the property. And that was mind blowing for me in the first spot. You had told me that as a passive investor, I could just put my money in. And the second thing I asked him was on the deal. I go, well, I'm trying to sell another house to get my capital out. When are you going to be doing this next deal? And he goes, well, you can use other vehicles if you're worried about your sale going back and forth. Take your 401k money out. I moved it to a self-directed IRA. So money, Devin. So just kind of remember to state that for anybody that thinks they need cash, like cash, you can actually use qualified retirement income. You could take your 401k money, move it to a self-directed IRA and stick it in there. So anyways, thanks for helping me get my car punched on my first deal here. So back to upcoming events, May the 10th, 12 Central, how buying apartment complex has changed. There's a lot of changes that have happened. COVID, not COVID, now back to kind of a hot market. So we want to give you some insight on how we're making offers today. May 25th, we have, as I mentioned, an in-person event. If you are local or anywhere near South Texas, you're in Austin, maybe Houston, you want to come by, San Antonio especially, come to San Antonio. It'll be May the 25th. We are going to meet together 6:30 Central and have an old school meetup. So I'll be wearing a mask. I know I'll still have, but probably a lot of you are doing your thing. I got my vaccine shots, so I'm a vaxxer. But you guys come on over. I mean, everybody's all in their separate spots. Wherever you're at. If you're comfortable meeting in person, here's time to go. So, anyways, then we're gonna have a summer boot camp on June the 26th. So it's these seminars, conferences, educational courses that I consumed. I did, 1, 2, 3, 4, 5. I joined as much as I possibly could. And every single time you go to a different event, you're going to hear a lot of the same information because it's a process that we all follow to go buy these big deals. You're going to learn about it. If you don't know how to do it or you have no clue whatsoever, come join. We're going to teach you really soup to nuts in a day. And then also the most valuable part is networking, because if you want to go do these deals or get invested with other people that are doing these deals, you got to meet, you got to have an existing relationship. You got to start getting in each other's world. And this will be a great way for you all to come join us. So that boot camp is on June 26th. If you want to know dates, locations, registration, links, all that stuff, go to apartmenteducators.com/events. All the links will be there. And then our community on Facebook is growing. So join our Facebook group and you can do that as well. And so additionally, a lot of times we do networking after these events. We are going to change our networking up a little bit, our virtual network. If you don't know, I do a weekly Wednesday at 12 p.m. Central Standard Time, a meetup that's on Zoom. You all can, join us there any Wednesday. So we're going to start keeping this to virtual education webinars and then networking there on Wednesdays. I should have put my contact information. I'll put my contact information in the chat, at least the email. You guys can ping me. And then I think every single week our team sends out, that's probably the easiest way, sends out an email. We'll put the link to our weekly Wednesday in that email that follows for your attending. So hopefully you can come join us. We appreciate the opportunity, and we'd love to shake some hands pretty soon. So some upcoming events. What else? Have we missed anything on here?
Outstanding. Yeah. Looking forward to getting back to the live events. The boot camp June 26th is going to be extremely educational, valuable. There's so many different ways live events have helped all of us progress in our careers. There's really no substitute for it. So we're excited to put that on here this summer. So yeah, I think we can wrap it up here. Thank you. And go to apartmenteducators.com. Make sure you get on the list there if you're not already, and sign up for the upcoming events. We look forward to seeing you guys out. Thanks for joining us today. Thank you, Abel.
Yeah, thank you. I see your comment, Omar. Please keep the virtual meetups. Well, those are going to go every Wednesday at 12, man. So we'll send that link out to everyone. But thank you all for joining. Thanks, Devin. Thanks, Ruben. Thanks, Apartment Educators.
Guys. Have a great day.